Welcome to today's deep dive. We are absolutely thrilled you're here with us. Let's get right into it because today we are appraising a company that is fundamentally operating from a position of unparalleled strength.
Truly unparalleled.
Exactly. I mean, they are sitting on record-breaking backlogs and serve as a literal fortress within the global defense industry. But with the stock trading at $676.84 today, we have to ask a really difficult question. Is this equity actually priced for perfection? And more importantly for you as an investor, would you allocate capital to a wonderful business if you had to pay an absolute premium for the privilege?
Right. It is the quintessential value investing dilemma. To add some context, today is March 9th, 2026, and the enterprise we are dissecting is Lockheed Martin, ticker symbol LMT. They are currently commanding a substantial $154.53 billion market cap, and they're navigating what is unequivocally the largest domestic defense spending surge we have witnessed since the height of the Cold War.
So our mission today is to put on our value investor hats, tune out the daily market noise, and truly appraise the intrinsic value of Lockheed Martin. We have a huge stack of sources to synthesize today.
Yeah, we've got comprehensive financial evaluations, detailed analyst notes, and the raw data regarding how sweeping legislative shifts are impacting their bottom line.
We're going to examine the quantitative data, the management strategy, and the current market sentiment to determine what is actually driving this aerospace giant. So to keep our analysis structured, let's lay out the roadmap for the first half of this appraisal. Part 1, Chapters 1 to 3, Business, Management, and Financials.
Chapter 1, Business Understanding.
Let's break down their core business. Because when you evaluate Lockheed Martin today, you have to move past the legacy perception of them just bending metal and manufacturing aircraft. The sources outline a distinct pivot toward providing national security as a service, and the sheer scale of this operation is staggering. Exiting 2025, they reported a $194 billion backlog.
Which is massive.
It is. For context, that represents roughly 2.5 times their annualized sales run rate. They have years of guaranteed contracted work already locked in the pipeline.
And that backlog is the ultimate luxury in corporate finance, absolute revenue visibility. When we map this to the broader philosophy of value investing, it immediately brings up the concept of an economic moat. Lockheed's moat is arguably one of the deepest in the industrial sector, and the F-35 fighter jet is the crown jewel of that defense.
Generating 27% of their total sales in 2025 alone.
Precisely. But the initial hardware delivery is really just the tip of the spear. The true competitive advantage lies in the profound switching costs. Integrating an F-35 into an allied nation's military architecture is not a simple procurement decision. It's a 50-year geopolitical marriage.
Right, because once a nation adopts the platform, they are inextricably tethered to Lockheed Martin.
Exactly. They need the proprietary replacement parts, the continuous software integrations, the specialized pilot training protocols. It creates an ecosystem so sticky that migrating to a competing platform becomes financially and operationally prohibitive. It acts as a half-century annuity for the defense contractor.
It's a longer commitment than most actual marriages and significantly more expensive to back out of. And this ties directly into their broader corporate strategy, which they've branded 21st Century Security. They are consciously evolving away from relying solely on these exquisite platforms, the isolated multi-hundred-million-dollar vehicles, and transitioning toward a highly interconnected system of systems.
Across air, cyber, land, sea, and space domains.
Exactly.
And the underlying mechanics of that network effect are fascinating. If we look at their Aegis combat system, currently deployed by the U.S. Navy, we see this in action. Aegis utilizes cooperative engagement capability. This means if a forward-deployed destroyer detects a threat, a cruiser 50 miles away can launch an interceptor based entirely on the destroyer's telemetry. Every new node added to the network exponentially increases the lethality and resilience of the entire fleet.
The software connects the hardware, making the overarching system more valuable with each adoption. And when you look at the competitive landscape, the barriers to entry are practically insurmountable. You cannot simply spin up a disruptive startup to compete in this space.
No, absolutely not. It requires the highest tier of government security clearances, billions in specialized capital, and decades of entrenched engineering tribal knowledge. Furthermore, 72% of their total sales are routed directly to the U.S. government, with 53% allocated specifically to the Department of War.
They are less of a traditional corporation and more of an integrated extension of the United States' strategic posture.
Chapter 2, Management Evaluation.
But a great business model still requires exceptional execution. So let's focus on the people running the show. We have CEO Jim Taiclet, who actually has the operational experience of being a military pilot. He understands the customer's mission on a visceral level. And alongside him is CFO Evan Scott, who navigates the massive capital needs of the business.
Evaluating the executive suite is critical because even the widest moat can be drained by poor capital allocation. And from a pure value investing standpoint, their current capital allocation strategy is the true litmus test. There's a massive operational shift happening right now in 2026. Management is deliberately choosing to hold back on massive share buybacks.
Which historically aerospace primes have leaned heavily into to prop up earnings per share.
Right. But Tyclet and Scott are throttling back on those repurchases to fund what they describe as a step function increase in internal investment. They are approaching $5 billion for capital expenditures in research and development this fiscal year.
And to translate why that matters to you as an investor, they are actively building the physical capacity required to meet that surging $194 billion demand we noted earlier. It's a clear preference for organic business expansion over artificial equity inflation.
It is. But we have to acknowledge that this pivot has quantifiable consequences. If you look at their return on invested capital, or ROIC, it contracted down to 21.2% in 2025. Typically, a compressing ROIC would trigger alarm bells for a value screener.
Sure, it usually signals a deteriorating core business.
But the underlying context completely changes the narrative. The denominator in that equation, their invested capital, has expanded dramatically. The drop in the return rate is a direct mathematical result of them aggressively standing up brand new, highly automated facilities dedicated to next-generation missile and munitions production.
Which naturally takes time to scale to full utilization.
Exactly. It is short-term margin compression absorbed in exchange for securing long-term throughput capacity. It's the hallmark of a management team confident in their forward revenue visibility.
Yeah, that makes total sense when you look at the timeline.
Chapter 3. Financial Health.
So let's dive into the numbers and bring this down to the quantitative reality of the equity today. As of March 9th, 2026, the stock is trading at $676.84. That valuation assigns Lockheed Martin a PE ratio of 31.27. When you benchmark that against their 10-year historical average PE of 20.27, the divergence is stark. The market is assigning a severe premium. So why is the market paying such a premium?
To justify a multiple north of 30 for an industrial manufacturer, you have to look past the income statement and scrutinize the free cash flow. It is the Warren Buffett gold standard. Lockheed generated an incredible $6.9 billion in free cash flow in 2025. What makes that figure particularly impressive is that they achieved it while simultaneously executing an $860 million early payment to eliminate a future pension obligation.
That is a highly prudent deleveraging maneuver. But speaking of the balance sheet, a cursory glance might give you pause. We are looking at a debt-to-equity ratio exceeding 300%. In almost any other sector, that degree of leverage is terrifying. But defense accounting requires some nuance. A substantial portion of those liabilities are categorized as contract liabilities.
Which is entirely different from traditional debt.
Right. Think of it like hiring a contractor for a major home remodel. You give them a huge chunk of cash up front before they ever swing a hammer. In the defense world, this is advanced funding provided by the government to initiate production. It is essentially zero-cost float. The cash sits in Lockheed's accounts, but because they owe the Pentagon a finished product, it remains on the balance sheet as an unearned liability until delivery.
It's a structural advantage, not a solvency risk. But despite that incredible tailwind, we still must arrive at a concrete intrinsic valuation. The sources provided a comprehensive discounted cash flow model, utilizing a standard discount rate and baking in their projected capacity-driven growth. The fundamental value of Lockheed Martin's equity should rest between $590 and $645 per share.
So a $645 ceiling on the DCF is highly revealing. It means right now the stock is trading at a 5 to 10% premium. Even if we assume flawless execution on that massive backlog, the market has already entirely priced in the growth.
The optimism is entirely fully valued.
Part 2, Chapters 4 to 7, Market Sentiment, Ownership, Risk, and Final Conclusion.
Chapter 4, Market Sentiment.
So if we contrast that soaring stock price with what the analysts are actually saying, we uncover a huge disconnect. The consensus from Wall Street is merely a hold, with an average target price well below the current market value, hovering roughly between $610 and $657.
We are witnessing a classic divergence between fundamental caution and technical momentum. Fundamentally, the analysts know the equity is fully valued. Technically, however, the stock is surfing a relentless wave of macroeconomic optimism. The sources point directly to the prevailing Trump trade narrative, which heavily emphasizes aggressive domestic defense expansion.
And the momentum is wild. The stock is sitting a full 40% above its 200-day moving average.
And that momentum was supercharged by a highly publicized catalyst. In March 2026, a White House meeting convened defense industry CEOs, resulting in a publicized mandate to quadruple production of critical systems. Now, the logistical reality of quadrupling aerospace production is years away, but the headline alone acted as an accelerant for sentiment.
And pointing out to the listener here, the short interest is incredibly low at just 1.28%. Almost no one is brave enough to bet against this momentum right now. It's unabated, long momentum.
It's a runaway train.
Chapter 5, Ownership Structure.
To fully understand why the stock maintains such a rigid premium, you have to look at how Lockheed's ownership provides a massive floor for the stock. An overwhelming 77.2% of the outstanding shares are held by institutional investors. BlackRock actively added shares late last year, though UBS did trim their position slightly. But that aggregate institutional dominance severely mitigates the risk of sudden retail sell-offs.
But what about insider trading? It always sounds scandalous when you hear it. And CEO Jim Tacklet and executive Stephanie Hill recently sold shares in February 2026. Does this mean executives are abandoning ship at the market top?
You have to have the crucial context there. These specific transactions were not discretionary liquidations reflecting a lack of faith. These sales were executed primarily to cover tax withholding liabilities associated with the routine vesting of restricted stock units.
So it's just a required tax payment?
Exactly. When executives are compensated with substantial equity, it generates an immediate tax burden, necessitating the sale of some shares to satisfy the IRS. The CEO still holds nearly 44,000 shares directly. Management's money is still very much where their mouth is.
That's reassuring. So let's look at the real threats.
Chapter 6. Risk Assessment.
As a value investor, you have to frame risk as the permanent loss of capital. Beyond daily volatility, what could actually go wrong and fracture this business model?
We have to contrast two massive neutral geopolitical factors. First, the opportunity. The 2025 One Big Beautiful Bill Act, or the OBBDA. This legislation represents a generational $150 billion mandatory funding windfall, specifically earmarked for defense modernization.
And that word mandatory is key. It bypasses gridlock congressional appropriations. It's just guaranteed liquidity.
Exactly. It's the ultimate systemic tailwind. But counterbalancing that is an equally potent threat. The 2025 tariffs on imported steel, aluminum, and critical electronic components. Lockheed Martin is an advanced manufacturing behemoth. They consume astronomical volumes of these materials. The direct financial friction from these tariffs caused a $485 million hit to Lockheed's cash flows last year alone.
Wow.
And we have to connect this back to Chapter 3's financials, because 60% of Lockheed's contracts are fixed price. They committed to delivering complex platforms at a predetermined price point years in advance. When inflation and tariffs spike the cost of materials, the government does not absorb that variance. Lockheed has to absorb the overrun, squeezing their margins directly.
Which is forcing a radical and expensive operational pivot. To insulate themselves, they are transitioning from highly efficient just-in-time supply chains to highly resilient just-in-case supply chains, meaning they are hoarding inventory. And warehousing vast stockpiles of aerospace-grade materials ties up immense amounts of working capital.
It's a persistent drag on their free cash flow.
Chapter 7. Conclusion.
So let's synthesize everything we found today. The bull case is anchored by unparalleled structural stability. The company has a $194 billion backlog, ensuring years of revenue visibility, an impenetrable economic moat, and a capacity expansion that could accelerate growth to the 6 to 8% range.
Conversely, the bear case is that there is zero margin of safety. At a 31x PE, any misstep in those fixed-price contracts or supply chains could cause the stock to tumble back toward its historical baseline.
Reiterated the final verdict to you, the listener Lockheed Martin operates as a definitively wonderful business. But right now, at a 5 to 14% premium over its intrinsic value, it might be trading at more than a fair price.
Right.
For established long-term holders, it's a fortress. But for new buyers today looking to initiate a position, it might be wise to wait for a technical pullback.
I completely agree. The fundamentals are incredible, but the price is steep. And that leaves you with one final provocative thought to ponder on your own. We discussed the transition to a 21st century security network acting as the digital connective tissue. If Lockheed Martin successfully executes this pivot, what happens to their valuation when the physical hardware, the planes and missiles, eventually become secondary commodities? If the true value lies entirely in the software connecting them, we aren't just looking at an aerospace manufacturer anymore. We're looking at a defense sector SaaS company, and that is a completely different kind of moat.
This analysis was generated by AI for educational purposes and should not be considered financial advice. Please do your own research before making investment decisions.
Thank you so much for joining us on this deep dive. Keep scrutinizing the data, keep questioning the consensus, and we will see you on the next one.